Good afternoon, everybody. Hope everyone's doing well. Um, got what should be a good conversation this afternoon. We obviously had the macro mid-quarter update today, but before we get into that, I do need to do a little bit of sort of, I guess, legal disclaimer work here, and want to direct everybody to the disclaimer link that I will be putting in the tweet nest just for any commentary and stuff like that that's going on today. So I'll put that up there in a minute. But with that, that's kind of all I got to do from the legal side, and so we'll dive right into it. Hopefully, just like 2 weeks ago, we've got kind of the live version on YouTube and I believe Hedgeye TV as well, and so you can kind of be looking at my screen and listening in as via Twitter Spaces. So we got that going on again today. So Paul, so last week we were in Dallas, had a great time in Dallas at the Dallas Regional. Lots of great conversations, wonderful presentations by the analysts, and an impromptu stopping guest by DiMartino Booth. So a lot of wonderful conversations that transpired there. We do have Miami coming up on January 24th. So just want to remind everybody of that. So if you haven't signed up yet, would highly recommend taking a look into it. But yeah, so I see some wonderful faces out there. X2, welcome. Andrew Palmer, always a pleasure. Why don't we kind of get into what we're seeing out on the board? So obviously this is it's fun, kind of a bit of a change of pace here where we get to do a sort of a live session during market hours. And right now, as you can see on my screen, I got the Euro US dollar pulled up. I think currencies in general are kind of in a pretty interesting spot here. So on the macro themes update, we saw that Keith gave us the trend line for the dollar at 103.26. That trade is kind of higher up there at around 109. Again, these are dynamic; they do shift. So that's not sort of don't take that in 2-3 weeks from now, but certainly in this time frame. Just want to kind of share what that looked like today. Obviously, once that dollar broke through trade, it's kind of it's not remotely close to trend yet, but it certainly has moved lower, and you're seeing that with the inverse correlations across the board. You've got the S&P on a 15-day basis is minus 0.87. Commodities are negative 0.90, and gold's on a negative 0.96. That's on the 15-day, and they're all, and they remain, basically negatively correlated across time frames. If you look at the 15, 30, and 90-day, which we all get on the macro show, but certainly, Keith called that out this morning, and just want to reiterate that that's certainly something that's been jumping out of the page really over the last few days. But certainly, again, if we kind of take a step back for what this show is all about. It's about assessing kind of what we reviewed over the weekend and the setups that transpired, obviously, late last week while we were in Dallas. You had the kind of big bear market rally, that 7-day rally on Thursday. And, since then, obviously, it's been a little choppy. And I think this is pretty much the definition of the chop bucket. We're here at kind of 24 and a half on the VIX. And it's got sort of that trader psychology, the market psychology is at play here. So just kind of sticking with the course. The mid-quarter update was, I think, obviously very timely. They kind of come out today or this morning, just reiterating all the data, right? The data points that's what we see on the horizon. I think it's obviously very telling. I'm going to pull up 2 charts in particular that I think are worth sharing with the world, because they're very important, and it's around kind of our sales growth and earnings growth and what that could look like, or what transpired the last time we had kind of big earnings recession and back in the 2000 to 2002 timeframe. So kind of want to so dollar. The other component is obviously, treasuries, right? So you've got the 10-year and the yield curve transpiring, right? The 10-year is certainly kind of down at the low end of the range here, midday. The 2-year is similar. Well, not quite. It's at spot 4.372. But then if you kind of look in, so that yield curve then is going to kind of not quite look quite as bad as it did this morning. I would have to think. Yeah, so it's still down at actually it's worse. So yeah, so that makes actually a lot more sense. Sorry, but minus spot 656. So yeah, so it basically remains very much an inverted yield curve that's putting in new 1 month, pretty much new lows across the board on a 10-day, 15-day, 1 month, and 3 month basis. So keep watching that yield curve. Again, I mean, for all this chop that we're having, pretty much everything is really exactly what we've been talking about throughout the last number of weeks, number of quarters, really, to be perfectly frank with you. So it's really kind of just status quo out there in my mind. Staying patient. It's not necessarily having, just kind of minimizing those feelings and just sticking with the process. I think that's a big piece today. Again, if you listen to the macro, the mid-quarter update today, the kind of the last, I guess, call it 50 seconds of that show. Keith just reiterates staying with the process and to try to live in all three of those durations on that sine curve. I think that's a huge takeaway. It's certainly something that I've I wrote down and am reiterating every day in my process. So let's maybe open it up to some questions here, and we can go from there. As I kind of anticipate some speakers popping up. The other, obviously, again, coaches talked about this this morning and yesterday, but those widening risk ranges are obviously something to absolutely call out. The sub 10,000 number on the Qs on the risk range, and so I'm kind of trying to still incorporate this video component. I realized that I could show people what I'm talking about. So the Nasdaq, right, sub 10,000 on the low end of the risk range, that actually widened out mid morning, as Coach noted in an RTA. And then the 10-year, same thing, that top end kind of moving up to 4.36. The dollar putting in a lower low and a lower high at the same time, right? So it's widening as well. That 113.45 on the top end. I think a lot of this stuff's all dollar correlated at this point in time, and I think it's going to be interesting to see where that shakes out as we move out in time and space. The move obviously is another thing to be kind of paying close attention to. Took a cup of coffee down below, I believe it was trade, and now we're back up to that 128 and 129 level, and really volatility across the board. Although it has been somewhat suppressed on kind of a month over month basis, it's kind of taken a little bit of whether it be the VIX are sort of kind of popping off the lows here, kind of making a higher low certainly in the VIX. What's the VIX doing at the moment? Pretty similar here, steadily in the chop. The F bucket. And then we got RVX for the Russell, same thing, kind of popping off those lows. So not quite back up to the F bucket on the Russell, and you're kind of seeing that reflective in the risk range, right? That top end at just north of 1900, but that low end still down at 1735. So really important to kind of keep track of those risk ranges and what that means, especially as we kind of go a bit more time and space. So if you kind of look at that Russell there, that 1 month, excuse me, that 1 month low is really going to start to fade out come Monday, and it's going to start to move higher. So that low end of the risk range is all of a sudden going to start to creep in, and if the probabilities of that happening, it's just math. So on an immediate term basis, the low end of the risk range is very probable, and if that happens, then all of a sudden, kind of come next week or really in the next few days, it could be that low end's going to be putting in a new 1 month low. So just always kind of keep track and keep a steady kind of focus on where those ranges are, the directions that they're taking, not only on a day over day, but certainly week over week and month over month basis. It's all really important to track on a rate of change side of things. So again, nobody came up to speak, but if anybody's got any questions or commentary, by all means, feel free to jump in. I will say what Coach sort of snuck in his. Well, he didn't sneak it in, but he sent me over his re-rank for the day, and so that'll be going out to Macro Pro subs here in a few minutes if it hasn't already. So I know he was a slight seller of BTOL and XLP, and added to AMLP and XOP. So kind of some of those energy names that are off today. So that's AMLP there on the screen. and XOP as well. So those are all, very strong in terms of really good signals and ones you want to be adding to. He also just sent me a quick note about an updated signal strength. So that's great. So I've got those here too. Again, I can't give you all of the that information, but good to have in my back pocket. Yeah. So Eric, all right. So I've kind of gone through my spiel. All right, Muni Guy. I saw you did an update, which was awesome. Hey, Brian.
Hey, Robert.
Welcome.
How are you?
I'm doing well, buddy.
I just saw you were on, and nobody else had popped up to speak, so I thought I'd jump on and.
Yeah, I appreciate it. I kind of did my 10-minute, monologue there. So kind of things that I've been looking at. I saw you. I retweeted your commentary. I think that was this morning, right? You kind of gave a little bit of a rundown on the munis.
Yeah.
Yeah, that was great. So thank you for doing that. I know a lot of people really appreciate it.
Yeah, happy to. Normally, I kind of prepare some notes before I jump up, but I haven't. I actually this new time slot kind of catches me off guard because I'm in the middle of the grind. So I just saw it, but I just put out a tweet. I'm pretty darn shocked. I put out a tweet earlier today with the 10 a.m. read on muni rates, and we were seeing
Yep.
a 3 to 5 basis point bump at 10 a.m. And they just redid it for the 2 o'clock, and now we're seeing 13 to 15 basis point bumps, which in my world, that is massive. Like a 13 to 15 basis point bump yields downward is a monster move. And we sold a $90 million it's Lexington, Kentucky, but it's Fayette County school district AA rated credit, really good credit yesterday, and it came in really strong. So as I tweeted out this morning, just on kind of before the market opened, what I'm seeing just from a supply and demand perspective in the muni market, we're entering that period where there are less trading days in the year. People are closing up their books. There'll be some days that the calendar is pretty heavy because people have to get deals done, but it's going to start slowing down. And, with the Fed hasn't pivoted, right? The Fed has said they're going to slow down the amount of the increases. And, if they go 50 and maybe 25 or 50 again, and then they kind of, reach a point where they sort of hold. We've seen inflation looks like it's peaked, and it will continue to trickle down from here. How fast, who knows? It probably is going to be sticky, but we don't know what we don't know. It's just math. But it just we're kind of out of that. What to expect. I think there's a little bit more of a visual on what to expect, and I really feel strongly that we had a low interest rate market that forced a lot of people into dividend, producing stocks, and now you can rotate out and get meaningful yield. And then, as you said, this earnings recession that's coming, to me, that's the next, really big catalyst that prices in maybe more of a traditional quad four, where quality rates, treasuries and all, people are going after that. You start seeing the rally there. And you go back to sort of what I call Hedgeye 101s for the first day. I looked at that one sheet that tells you what works in what environments, and
the quad math.
Yeah, and we've stayed away from rates, right? And now it's like maybe the stars have kind of aligned to where we kind of see the traditional quad four. And I think Keith mentioned that we might see, either he said it on the macro show yesterday or he tweeted it out, but we might start seeing more of the traditional kind of quad four makeup potentially, going forward. But
yeah, no, it's a good call, Brian, and I think a lot of that does to do. And Brian, I think it's a great call out, and some of that does have to do with the bucket of volatility that we're in. in terms of it being in the chop bucket, and certainly down here, the kind of sub 25 range, the equity has definitely become a bit more investable, especially, high quality, companies, as you said, with sort of a strong balance sheet and really good visibility into cash flows and earnings, right? So he's definitely mentioned that a number of times over the last couple of weeks, and I think that's really something to be paying attention to. I've got quality up here on the screen. And again, most of those names, even low vol, high dividend, it's been another pretty good area to have some exposure to over the last month. And that's no, it's definitely a good spot to be. I think just going on the earnings thing there. I'm kind of sharing, if you're on the YouTube, I'm sharing the Nasdaq sort of 2001 cycle, and really kind of the quad. That was the last time we had multiple five quad fours in a row. And you can see here we're kind of right in this sort of these Q3 numbers kind of lined up more with like that Q101 time frame. And so we got some pretty likely pretty nasty earnings recessions on the horizon
Mm-hmm.
here as we kind of move out into Q4, Q1, and Q2 of 2023. The other interesting thing I think is, if you kind of look at the returns, you had almost, three, negative 25 plus, returns in each consecutive year. So minus 26, minus 38 in the 2000s, minus 26 in 2001, and minus 39 in 2002. So, that's something. I think this is I shared this on a beginner's guide 2 weeks ago. In terms of the kind of earnings recession and that kind of thing. And I think this is a really key call out. Again, history doesn't repeat itself, but it certainly often rhymes. And so, just kind of keeping that in the back of your head as you kind of walking through some of, what you're seeing on the screen right now, and the sort of immediate term kind of bear market bounce that we've received.
Yeah, and so I also pointed out this morning that the low end of the 10-year risk range was 375. So we're at a
Yeah.
371.4 right now.
Yep.
3.714, not 74, 3.714.
Yep.
So, we broke through the risk range here. And so just looking at, I sent you that tracker that I do. We had all that red on the lower lows, and now all of a sudden we get a green day, a red day, a green day, a red day. And now we're going to have 2 green days in a row, and then my guess is tomorrow we'll probably have another lower low based upon.
Yeah, so on the mid quarter update, Brian, I don't know if
I
you listened
haven't
to it, but
yet.
he did. Okay, yeah. So Keith did mention that the low end of the risk range moved down to 3.70,
Oh, okay,
and that remains above
okay,
trend.
okay.
So again, yes, the certainly the one from this morning, it's below that, but it's that updated one again. That call happened at 11, so take that again. These things are all dynamic, but yeah. So it's kind of we're kind of right at that low end of the risk range there in the 10-year as of the updated one from the mid quarter update call.
Yeah, and just from a red to green perspective, it just seems like we're starting to see more green days, meaning for me it means lower lows instead of lower highs, and we'll see if it continues.
Yeah,
It might be a quality. It might be a quality versus HYG junk spec stuff. I don't know.
yeah. I mean, I think the thing there though, Brian, to remember is like not just look at the low end of the range, but also look at where the top end
Yeah, it
is,
moved
right?
higher, it
And
widened.
at 4.36, that's a significant new, basically certainly cycle high, and the way that we often look at it and measure things in terms of the 1 and 3 month basis, that's a big time new. Would be a new new highs across those parameters, right? So just I think it's yeah, as I said, it's important to kind of keep track of all aspects of that, and knowing, and conversely too, right? If let's just say, we, again, I mean, he mentioned, I think on Friday or Monday, to your point about some of these more traditional quad four asset allocations might be circling back up, to kind of be playing, quote unquote, back tested normal ball. And what you'd want to see there in that 10 years for the top end of the range to be putting in basically a lower high, right? So you'd want it kind of, on the top end right now, it's around 4.25, call it, right? So you'd really start wanting to see that top end of the range, putting in a lower high, and then obviously kind of lower lows, which it has been doing kind of on a 1 month basis. So again, just kind of like as we start to go down the path here, the other thing too though with that component, you'd want to see kind of the move breaking down, and his commentary was really kind of around when the move was sort of testing a key level. I think, so that's kind of definitely something to be paying attention to. But good call out though,
Yeah,
buddy.
and let me pivot on you
Yeah,
for a sec. I sent a tweet out
yeah, let's do
maybe
it.
over the weekend. Uh, just it was in part, and I didn't mention it directly, but it was in part of the FDX. I think it's FDX, um, and crypto, and I am obviously when I tweet out my current portfolio setup, and I'm now 51% individual muni bonds, and the rest of it's basically cash with a few other positions. I'm a super conservative, ultra conservative um, person, and I've been very open that I'm waiting for Hedgeye to tell me, hey, all clear, no more quad fours, and we can get back in equities, and that's kind of just how my process works. But I owned
Yep.
a tiny bit of crypto, and when I say a tiny bit, I mean kind of a small amount that I had to take out of a betting account that I had, um,
Yep.
and they said get the hell out, so I sold it and got out because and I will say that one of the things that I have learned to appreciate about Hedgeye, not sort of the process, but just sort of like warning signs, is this entire thing that has decimated people's lives was entirely avoidable, and it was avoided by anyone who just listened to logic and the not just Hedgeye but the network of Hedgeye. And I made sure to say the network because of Commodities. You know,
Codes. Yep.
just if you were in crypto, let's just say you had 5% of your money in crypto and you moved it out. I mean, that is, I can't even tell you what impact that is. I mean, if you had $10 and someone stole, a dollar of it, you'd be mad. And here you got like, people have massive amounts of wealth in crypto, or now they can't even get their money out because they took counterparty risk that they didn't even realize. And so, on an off topic, not process related, but more of a warning sign related. When Hedgeye says, or the network of Hedgeye says, like stay out of this crap, like stay out of this crap. You're not smarter. Don't anyone out there listening, don't think you're smarter than these guys, and you got some edge, and you found the next greatest widget. Like they'll sniff it out before you do, and so I'm happy that I sold the tiny bit that I had, and I have zero exposure to any of it. It's more entertainment at this point. Hopefully watching these people go down for what they've done. But that's off topic, so not part of the
Yeah.
process.
All good.
But I'm going to jump
All
off, but I
good.
just
All
wanted to
good.
jump on real quick.
Yeah, no, I appreciate it. Yeah, sorry. Before you do that, Palmer did text me. He can't talk at the moment, but I don't know if you've got any thoughts on this one, but he was curious, kind of just around volatility and basically how things are sort of playing out with the VIX and the S&P and sort of the those the kind of correlations and that kind of thing. Are you? I mean, I think you're pretty kind of, I won't say letter to the law kind of guy, but sort of certainly, operating on the fringes is I believe, kind of where you traditionally execute. But, I don't want to speak for you, but that's,
Yeah. So,
yeah.
so that spreadsheet that I've sent you before, Robert, that I track,
Yep.
and I do,
Yep.
red, green, and then gray for no change. I've been tracking the
Yep.
Nasdaq. So since August
Yep.
12th, so I'm at this Friday will be 70 days worth of tracking, and so I track the volatility
Yep.
each day, and I monitor it, and then I line it up with Fed meetings and CPA, kind of event days, and just to give me sort of a viewpoint and an appreciation for kind of what potentially drives the macro tourists that then create opportunities when reality hits. And
Yep.
from my side, I see this continual drop in um, volatility in the NASDAQ. And I think, again, we're kind of in a place from the Fed perspective on increases that people kind of have a comfort level of what's coming and how to navigate it. But to me, what's next is this earnings recession, and so we might have to live in this world where we continue to set up, and you got to be careful not to get faded. And you notice that on real time alerts, Keith shorted Qs, so I shorted Qs because I always like to do the macro, but I actually closed my short out a little bit quicker, but we ended up with the same return. We both ended up with a 1% gain. Um, and so he's playing within the risk ranges, and he's playing that volatility very tightly. But you notice he didn't wait until playing for the 5% drawdown on Qs here. And
Yep.
if I'm reading sort of what I've learned over the last year, it's that the setup right now might be for the macro tourists to get a few wins before reality sets in again. And when that happens,
Yep.
I don't think you can know when that's going to happen. But the NASDAQ to me is just irrational. It's an irrational thing. And I like the risk ranges because it kind of gives you an idea when it's truly overvalued, and you might have an opportunity to make a 1% gain. And if you then I do the 3 times thing, so 1% was 3 times, and SQQQ. And for anyone out there, like Macro Pro, that's one of the tickers that's in the Macro Pro. So that's the only reason why I do SQQQs, because Hedgeye has it in the Macro Pro. Then I'm comfortable that it's comfortable using it. May not use it like I did one time where I, didn't realize it was 3 times. I now have a full appreciation of what 3 times is. I just think that volatility here, if I had to guess, I would say that we're going to continue to trend down in volatility unless there's an event. And I will make it one step further. I track SIFMA, which SIFMA is a tax-free weekly rate. And then what they do is they do leverage. So you can borrow at, under 3% and then buy 5% coupon bonds and then keep the spread. And so now I've been out of leveraged funds, and I put out a tweet that said leverage may start to make some sense in terms of portfolio construction on the fund side, because they now have more of a known commodity in terms of how much they can leverage and squeeze in terms of juice. So when you're kind of getting towards a potential end of the Fed hike cycle, they may hold rates, but they may be at the end of the hike cycle. I think leverage could start playing a factor again. But again, I didn't take that route. I've been buying individual bonds. But so that's my 2 cents on the volatility, what I'm seeing in terms of how I'm tracking it.
Yeah, and I mean, you kind of stuck where I thought you'd go, Brian, which really is, just to me, it's keeping it simple rather than kind of, again, Palmer, I'm not like poo-pooing on your question at all, because I have fielded it a number of times over the last week, to be perfectly frank with you. But, the math is the math, right? I mean, I don't think, overthinking anything is really not worthwhile, in my humble opinion. And I was telling folks at Dallas last week, it's the, I try to keep things relatively simple. Obviously, there's a lot of different components that go into the decision making in terms of looking at looking at the dollar and where it is in its risk range, going to the 10-year, the U.S. 10-year, the VIX, the move, the euro. It kind of goes, again, I look at a lot of different stuff all at once. But in terms of actually making decisions, it's sort of the risk range, or certainly kind of just looking at the numbers and the data and knowing why volatility is being suppressed. I really don't care, nor does it impact. It's not even, is it being suppressed? I don't know if it's being suppressed or not. I don't really care. All I know is that it's down into the kind of middle half of the chop bucket. And so with that in mind, it's basically, you kind of pivot the way that the portfolio can be constructed. And as such, you can incorporate more equities. And you've seen that over the last 3 weeks by Keith, who's expanded his list of longs, as Brian, as you were alluding to, in the Macro Pro product, and from there, you kind of shift the portfolio kind of construction. You maybe you kind of are a little bit more patient on kind of adding back to the short side of things, if that's something that you do. And if it's not, then you kind of go and you look to for securities or asset classes, call it inventories, with strong signal strength. And you again, just to piggyback off of the coach who sent this over to me before around the start of the call, adding to things like AMLP and XOP on red, right? So just kind of taking advantage when the market gives you those, even though they may not be quite at the kind of low end of the risk range. But yeah. So with VIX in particular, the other thing too, Palmer, that I'll say to this is, that top end of the range is squarely within the chop bucket, right? So unlike the last sort of call it prior 2 weeks or the prior two kind of notebook reviews, where we were still flirting with the top end of the range. I think last week it was what was last week, the 9th, maybe the 8th, no, 9th. The top end of the range was 29, just north of 29 and a half. So I'd call that kind of right at the top end of the chop, right? So kind of still somewhat flirting with the F bucket. So again, as we've kind of kept going out in time and space, we're currently pretty squarely in the chop. And so, again, if I'm looking at these risk ranges and kind of looking at the market, what I'll be looking for, or what I think, most should be doing is seeing what the kind of low end and the top end are signaling, right? And whether or not those are signaling kind of, new 1 month highs, new 1 month lows, and what have you, right? And sort of, seeing if that low end is putting in a lower low or lower high, and conversely for the top end of the range. So those are going to be kind of, to me, pretty key signals to be paying attention to, and then it becomes an execution in regards to the when, aka timing of some of your decision making.
So Robert, do you have the RTAs in front of you?
Yeah.
Do you like I pull it up on my screen and I just look at it every now and then, but
yeah, I mean, I have them. I mean, yes, it's not. I'm not currently sharing them.
Okay, so there are 4 longs right now in RTAs. There is one I think everybody needs to watch to see if he double dots it, because I am waiting for the double dot, and I'm going to hammer the living shit out of it when he does it, because I'm not smart enough to know when to do it. But it's a slow mover. It's one that, I only play a few positions now. I've really gotten to just only play like 3 little positions, but when I hit them, I hit them. And which one do you think it is?
I think it rhymes with Trixie.
No. UUP.
Yeah, Trixie. So the Dixie, aka like.
I'm sorry.
UUP. I'm sorry. I was trying not to give away the ticket.
Oh, okay. Never mind. So, well, I gave it away. Sorry. So when he hits UUP double dot, I can tell you right now, I'm hitting that thing. But I sold a bunch of dollars, and I did. It's one of the only positions I do mid max. I usually do 6 kind of dots instead of 3 dots for me, and because I don't want to get faded. And so on UUP though, it's the only one that I do 3 dots, so I'm down to 1 dot, and it looks like on paper I'm getting crushed right now, but really not. I will double up on it, and then I'll get the run, and I'll make money. It's just being patient and setting up for the next cycle for UUP. So, but it's a great learning, I think, piece right here. This moment in time is a great learning moment, I think, for people that are just starting out, or have less than 1 year under their belt like me. UUP is one that when he hits the double dot, you know what to do. So I'll leave it at that, man.
No, it's a good call out. And again, I mean, I don't really know how to draw on here, but let's see. Is there a way for me to make? See, I know my boy, Thousand Arrow Effects, know how to do this. But basically, I'm trying to draw an arrow, if you're watching this online, from the beginning of the year up to where we are today, and that is what you call an up and to the right. So, again, it depends on when you got into it, right? If you joined Hedgeye in last month, it's probably been a little painful being long the dollar, and or kind of trying to assess, what you're trying to do with that position. But for many of us on this call and or who've been Hedgeye subscribers for a while now, the dollar's been an absolute rock star of a position since the beginning of the year, really since the beginning of kind of we were calling for quad fours. And again, we've talked about this a lot on our calls. Oftentimes it does kind of, quote unquote, matter as to, when you sort of start to deploy the process, because it can kind of influence, what, again, especially if you mess up sizing and timing, right, Brian? To your point, if you got what you thought was kind of got big, say even like a week ago, that would be pretty painful right now. So I'm with you there, Brian, in terms of being patient in regards to and paying close attention too, right, as to like when coach kind of signals that second dot, because he'll do it.
Oh, yeah, he'll do it.
Or at least I'm pretty sure.
Well, I'm going to jump off and just before I go.
Yeah, awesome, man. I appreciate it. No, thanks, Brian.
Gavin and Jimmy they got this cool little blue dot with a check mark, and I'm really jealous. I don't know why I don't have one. And I thought
$8 a month.
I need to get one, and I tried one day, and they took it down. And I thought, oh man, I missed my window. Maybe I'll get my window again. So, but you guys have a great day.
I didn't even notice, Brian. Yeah.
You don't have one, Robert. Come on now. Get with the game.
I guess I know. $8 a month. That's two coffees. I know. Right, Brian? Or maybe like a put position on something.
That's true.
So
That's
anyway,
true. All right, take it easy, guys.
Awesome, buddy. No, thanks for jumping up. Welcome, Gavin, Jimmy. How are you guys doing?
What's up, man?
I'm good, buddy.
Yeah, I figured $8 was like okay, because I mean, I just figured it would be good to like let people know this is the real. Since I had a couple like fraud accounts, but now I guess people are like paying $8 to be frauds anyway, so it's all a mess. But whatever, it's $8.
You're the real deal, Mr. Holyfield.
Yeah.
You jumped on when I was talking the dollar. That does not surprise me.
Yeah, well, I'm definitely long the dollar. So I've had I was definitely surprised. Basically, like if I look across and zoom way out as far as I can in all of like the models and stuff that I have, it's we're at levels that it's interesting, like how the market will push right up against levels that would really start to concern people, I think. And then when you see this, widening across all the major risk ranges, and you can see that the snapback off that level, with the 9 days left we have in November, it's just a really interesting setup. But yeah, I'm long the dollar pretty big, and I've given some of my return back. I'm actually down about 2% for November, off of a high water mark closing in October, so it's okay. Right. But I mean, look, it's just the way it works. Like if I didn't buy the dollar in November, then I wouldn't have had my biggest month of the year in August when I loaded the dollar on the long side. So you just have to keep banging on it and then evaluate it. But it has gone further than I would have guessed. But I guess that's how markets work. When everyone starts to know something's happening, then the snapback could be that much more, violent, I guess. But we're hanging in, and I've kind of, I don't want to use the dirty word of like hedging that everyone uses, but I am, I've done some things with bonds and U.S. equities to kind of balance things to protect my downside from here as we like let this expansion and all the ranges kind of play out and see. I mean, the dollar risk range is very, very wide, so obviously a lot of upside, but I just kind of want to see it settle in before I do anything further. So just trying to maintain into the end of the year. And I'm starting to do some work into thinking, like I always like to try to, as anyone would, like come out of January like making money, because it's always easier to trade if you're up on the year and like to not let yourself get down on the year to begin. So trying to set up and see what's going to look good into Q1, what the play is going to be. But yeah, hopefully this dollar kind of settles out. And it's like, but I was thinking the other day, like with phase transitions, with this type of strength, to think that the dollar is just going to roll over from here and die is pretty silly. Like to think there's not going to be a tradable moment into December maybe, or to do something with. So yeah, that's kind of where my head's at right now.
No, it's a really good point, and I think I don't think you were on when I first addressed it, but yeah, I mean it broke trade at around 109, and that trend level is down closer to 103. So it's held in here, kind of at that last sort of consolidation phase from the summertime. I think that was kind of around August, and to your point, Gavin, it's always fascinating or interesting when kind of all of a sudden you get another slew of kind of buyers coming in, but it happens all the time. So kind of knowing where those levels are is very important.
Sure. Yeah.
Cool. Jimmy, welcome. Always a pleasure. And then Nicholas and Shiv, I'll come to you guys afterwards. But Jimmy, how are you doing, man? How you called out healthcare. I think that was 2 weeks ago, and it got quickly added to ETF Pro. So well done on that one, buddy.
Thanks, man. Good afternoon. Yeah. Just wanted to listen in. I missed it last week, but obviously we've had a crazy four-day bear market bounce, right? And today we're maybe giving some of that back, and there's a lot of narratives out there. My small caps have looked great, but they haven't been great all year. To Gavin's point about the dollar, we're right back to where we were in mid-August at the end of that bear market rally. So you're talking similar sets, and everything seems to be kind of maybe as you would expect, with some things at the top end of the range, some things at the low end of the range. The last time, I'd been looking for another chance to short crypto, but I had gotten kind of light right before this whole pukage. So it's been interesting to see just, I guess we have some updated risk ranges if you follow the crypto trend tracker, but it's been a really paltry bounce, if you can even characterize that. And I know that volatility had been really low, so there was either a breakout to the upside or to the downside. And it seemed just a week and a half ago that crypto was holding its own versus risk equities, especially just a week ago, Nasdaq, at the year-to-date lows. So we've had this. It's been a big move. I got ran over in a few of my shorts, but I've got some longs that I did really well in, and I've been, I think you'll appreciate it. For someone as bullish as I am, I didn't buy a single thing over the last 4 or 5 days. I've only added to my shorts with some patience, and I'm looking for a time to get even shorter, to see if we have any failed retests. But I just continue to be humbled by how much price drives narrative and how quickly things can change. And I have to fade my own feelings because I want the melt up. I want all-time highs, for my portfolio, for America, for retirees, for anyone that got rugged in crypto. So there's just a confluence of factors. But we got to be patient. We're not out of the woods by any means, and it doesn't take a rocket scientist to say that. But I do think that whether it's the machine or whether it's this hopium that we have in the market, that some of the factor exposures, like small caps that we've been talking about over the last month or so, like healthcare and some of these sectors of the market that are starting to get a bid, there is a reflexivity to it. So just even on a technical level, like a lot of the components of IWM that were just getting pounded all year never hit the middle of their ranges, right? It would hover between the middle of the range to the bottom of the range. It would puke from the bottom. You'd have a weak bounce. Just over the last month or so, I've seen them start to hover, obviously off of much lower levels now, between the middle to the top end of the range. So there's some algorithmic support And then you kind of see what happened with some of these earnings where people got caught off sides. The only thing that's interesting for me, I remember, so Keith, Coach talked about Netflix maybe a month or two ago about how the signal went from bearish to neutral to bullish, and like you don't press it at the turn. You kind of have to wait to the real shark line, that tail line. He called it out. It was north of 300. It was like maybe 318, something like that. So finally, we're starting to see these like double upgrades, and there's some price momentum. Like for me, those are the setups that get a little bit more interesting. I don't know that I'm shorting it today, but some of these tech names, the growth names, the SaaS names that have had, just really big short covering rallies on I don't know how much volume, look more interesting to me today. So that I'm still playing the short side mostly there, and I think Gavin yesterday talked about that hammer formation in the dollar on long dollars. But I do see a few signs here and there that some of the really beat up names that got completely thrown out, they put these kind of capitulatory bottoms and then they rallied. But then again, that coincided with this 4-day bounce. So for the names, I'm still tempted to add more to. I'm waiting for higher lows, if that even makes sense, within even a trade duration, because on the tail duration, you can just say it's consolidating in a bearish, pattern. But that's all I got for now. I'm kind of curious to hear the rest of the audience talk.
Awesome, man. No, it's no, appreciate it. Always appreciate your insight. I think the hopium, not that I'm laughing at the hopium, but certainly if you were listening to that May quarter update, the hopium would have gotten sucked from your soul. So just there's an earning recession on the horizon that we're gonna have to navigate.
That's right.
Yeah, awesome. Nicholas, welcome. Thanks for jumping up.
Hi, Jimmy. Hi, Robert. Hi, everyone.
Hey,
this is
appreciate your patience.
London here. That's fine. That's fine. Thank you. Just wondered, has there been a situation where we've been in the middle of 3 or 4 deep quad fours, and the dollar's rolled over and broken trade and trend, and has there been a situation where the dollar's fallen over a particular period of time or longer period of time than trade, and therefore risk assets have risen, and would that indicate that we're coming out of quad four earlier than forecast, or what are your thoughts on that?
Yeah, good question. I mean, I think last time we had sort of a huge ramp in the dollar, and I'd say kind of a similar situation in the bond market, stuff like that would have been in the early 80s, and there was a great slide in the macro themes in the mid-quarter update there that sort of highlighted the different periods and times where we've had kind of big bullish moves in the dollar. So I definitely would go take a look at that. But on my screen here, I do have sort of the dollar going back to that same time frame. And sorry, I'm just trying to open this up a little bit. And basically, again, I mean, there's definitely, even in that big ramp, I mean, we went from kind of the mid, like 85 to basically 165 over the course of 5 years on the dollar, on the Dixie. And, in between there, that the summer of 81, we kind of went from a high of 114 down to 102, right? So kind of a similar-ish range where we've done today. And then it ramped right from 102. Again, it's not obviously in a straight line, but as I said, kind of 4 years later, in the spring of 05, it kind of peaked around that 160 level. So, I don't have an overlay right now. I'm just kind of talking about the dollar itself, but nothing's ever really in a straight line, Nicholas. And just to clarify, it's broken trade. It has not broken trend. So that's also another key piece, right? So trend's still almost $3 lower from where we are today. So. Again, I think it's just, the inverse correlation right now is certainly, I personally, not personally, but that's just what the data is saying, right? The data is saying things are inversely correlated, and therefore, with dollar down, you get, S&P up, commodities up, gold up. So I think
Yeah, I quickly wanted to interject on the dollar just to finish up that conversation, because I think some of the, if you look across Twitter and other sources, people may be having a different timed, like a different duration on the dollar. So they'll say it's broken trend. I think, I trust Keith. He's been so spot on his dollar and UUP calls, that I'm more inclined to be patient. I know if you look on the weeklies, just the action of the last couple of weeks, it looks like on a trade duration, lower highs, lower lows, and it kind of fell out a little bit in the last week or so. But I'm being patient here. It's still quad four.
But what I'm saying is, if the dollar did break trend, is at 103, and it continued to fall, would Keith and Hedgeye, would they then say we're going to come out of quad four earlier? What happens if we're still forecasting quad four for another couple of quarters, but the dollar is breaking down? Would Keith then, what would happen to, what would the thoughts be about risk assets and equities in particular? Would one, because obviously if the dollar does continue to fall, equities are probably going to rise. We agree. Or are you saying that quad four is like the signals and the quad? The signals trump the quads. Would the dollar fall trump quad four?
it's a good question. I think right now the signal certainly is not saying, but you're absolutely correct in terms of, every quad is different, right? So the signal will drive the asset allocation and the core positions. And right now there's nothing at the moment in time to indicate that the dollar should be rotated out of our portfolios. Instead, with the outlook of we're just now into the kind of first really quad four here in Q3. Q3 was first quad four. We're now kind of halfway through quad four here in Q4, with another two more on the horizon going out to through Q2 of 23. But again, if you watch the mid-quarter update today, the GDP numbers were quite staggering. So although we have a quad one on the books, or sort of being kind of recorded at the moment as sort of a GDP growth, I mean, that growth is from basically 0 to 0.6, I believe, if memory serves. So it's it's not exactly like we're going gangbusters and the spigot's being turned back on. And again, if you look back in time, when the last time we had multiple, I think we had 5 quad fours in the 2001 era, which I mentioned earlier today. That's we had 3 big time drawdowns, consecutive drawdowns, right? So they were minus. Again, I said the numbers earlier, but call it minus. One was minus 25, minus 36, minus 25. I forget what the numbers are, but basically multiple plus minus 25 plus drawdowns 3 years in a row, even with kind of the pivot to a quad kind of one environment. So, right now I think you just got to stick with the signal, stick with what, just stick with the signal, right, and go from there.
Yeah. All right, thank you. When so quad four is, you're forecasting to be over in sort of end of first half, and then is it quad four for the third? Sorry, quad one.
Yeah.
For Q3 23 then?
Yeah, that's correct. We just basically those numbers kind of just started to trickle in, right, in terms of we just started forecasting Q3 this week. But yes, that is currently quad one on the books.
Okay, great. Thanks for that. I'm not Macro Pro. I've got Retail Pro and all the other stuff, but no, I appreciate that.
Yeah,
Thanks
absolutely,
very
buddy.
much.
Yeah, no problem, Nick.
I was just going to say, Robert, I think I have a lot of respect for Keith's signal on the dollar, some of the big stuff, VIX, and if anyone's signal has like momentum as a really heavy component, which based on my understanding, Keith does not have momentum in his signal. You can get really confused. A lot of people I track momentum because I think a lot of people track it and I want to know what they think. And so if you see the dollar, like UUP, the ETF, breaking, 3 months price momentum, everyone's going to freak out. And for me, like I love that kind of divergence where that starts happening, and then Keith with his the VASP signal is still bullish. That probably starts to get pretty interesting. So, I mean, based on what I have here, like I'm not seeing anything. I would still look at this as like the best opportunity to buy dollars we've had this year, based on like the really long-term numbers that I'm calculating. So that's kind of my thoughts. Which is, I guess the main point was just to be careful of, like, if other people are saying the dollar's breaking trend, it's like, well, what is trend for you? Is it like a moving average? Is it like, what is it? So that's it.
Yeah, and Shiv, I am going to pass it to you in just a second, but we got a special guest here in studio, the one, the only, the Mr. Richie, and if you're watching kind of on YouTube, we're going to overlay a chart that he just sent over my way, and he's going to kind of walk through folks what he's seeing on the dollar here.
Yeah, I just heard about the dollar overlay, and so I just want, can you put the chart up? It's coming. Oh, it's coming. Cool. So essentially, if you look at like 1980s, that bull market as well, we're only 30. Like today's bull market in dollars, only 30% of where it could, in terms of length, of where it was in 1980. So that blue line there, that's our current bull market. That black line's your 1980 bull market, and then the gray line is your 2002 bull market. So you can see, if we're let's just say we are in a Reagan, the Reagan Volcker era, and you have that bullish dollar. Well, we're only 30% of the way there, and as you can see, also by that black line, right, the dollar does go down. It's not just a straight line. Same thing with the SPX too. So just to further answer your question there, this bullish dollar, it's there. It's there, and it's there for quad 4. And your hawkish Fed does not help it.
Awesome. First timer. Thanks, Richie.
First timer.
Thanks, Richie.
Always glad. I watch the show every week, so good to be on.
Awesome. All right, Shiv, I'll you've been kind of waiting for a minute, so I'll pass it. But Nick, look, hopefully that helped. And again, if you look at the replay here on the YouTube, you'll be able to see that chart that Richie's talking about. So it's an overlay, but it's definitely early days, which is great.
Yeah, yes, I couldn't see the chart, but yeah, I'll have a look at the replay. Thanks,
yeah,
Ben.
Yeah, you got it, boss.
Appreciate it. Thank you.
Yeah, thanks a lot, Robert, for having me. Look, I'll firstly start off with a comment. I got to know about Hedgeye after the FTX fiasco, and noticing that one of your guests and one of your team members, when they interviewed about FTX, they called out the FTX fraud way before. And so I'm actually from Australia, and I came briefly to US to do my MBA at NYU Stern. So I've been in crypto for a while, and I've never used FTX because for some reason I never thought that is like the platform to use for some reason. And SBF, BS, I just didn't find that character. It seemed too good to be true, the way he was accelerating. So first of all, congratulations on all the recognition that you're getting from all over the world, even from down under, for calling out FTX what it was. And then I'll follow it up with a few questions. A couple of them. One of them would be crypto related, and the other one would be more of a macro related question. The crypto one is clearly FTX is the fiasco that has happened is a big contagion for the industry. And quite recently, and I'm sure a lot of the people over here would be aware that Gemini had halted its withdrawals. Now they're back up. But it seems like they had exposure to Genesis trading, and Genesis had, exposure in lending, I believe, a lot of exposure to FTX, allegedly. What are the centralized exchanges, according to you or the audience, who are, have got, they look into crypto? What are the centralized exchanges that I'm just curious that the consensus believes is trustworthy at this stage? Because of course, centralized exchanges do play a very important role if anybody wants to participate in crypto by being that fiat to crypto on-ramp provider, and then you can self-custody. But still, centralized exchanges play a big role. And when a player like Gemini, who quite honestly is very trustworthy brand, at least in Australia it is. And one of the reasons why it is because the largest bank of Australia, which is Commonwealth Bank of Australia, they announced last year that they are going to allow their banking customers to trade, buy and sell crypto within their app. And Gemini was the exchange that passed their due diligence test among all the other crypto exchanges that they said that they wouldn't touch. So Gemini holds some sort of a respect of being very compliant, and true to what one-to-one customer deposits are. So in the light of what is happening and a lot of cascading effects would happen within the crypto industry, what centralized exchanges are the people finding trustworthy at this stage? And my second and last question, I'll not take much of everybody's time, is that so I've heard a lot about US dollar. And look, before I got into crypto, I was big in currencies. And generally, what I've witnessed, observed, is that when gold goes up, Australian dollar goes up. There is a strong correlation between the currency and the commodity. Similarly, when Canadian dollar goes up, you generally see the oil goes up, or vice versa. I've noticed lately that the gold price has, gone up slightly in the last 1 week. So two questions around that. One, why do you think gold has been a failed asset class, failed asset during these inflationary times? Because generally there's this popular notion, because in 1970s gold did very well during that inflationary period, people generally think of it as an inflation hedge, but clearly this time, so far, it has proved not to be a good inflation hedge. Why do you think that is the case? And secondly, if gold price goes up, historically, it suggests that Australian dollar also goes up. What would it mean for the US dollar then?
Yeah, so first of all, appreciate the commentary and the shout out. I think from a crypto standpoint, I'm going to respectfully pass on that question. It's not really kind of speaking about contagion, just kind of something that I really have no insight and/or edge on. So it's just not really something that I'm knowledgeable on, really, Shiv. So I apologize, I can't really give you much color there. But secondly, on the dollar, from a macro standpoint, really, what we would call this is a counter trend move or counter trend bounce, right? And you're seeing that across the board, and due to the inverse correlation with gold at the moment. So it has a negative 0.96 inverse correlation, US dollar to gold on a 15-day, negative 0.84 on a 30-day, negative 0.88 on a 90-day. So those are all pretty significantly inverse correlated, and as a result, with the move of the dollar, it's many potentially other factors as well, obviously, right? But yeah, that kind of inverse correlation has caused kind of about a 4% move in gold in the last week. And yes, I mean, you're seeing similar strength in the Aussie dollar, even in the Canadian to US dollar, right? Pretty much everything, every FX cross denominated in USD is kind of having the inverse of, or sort of the is benefiting from that, going from what we would call the kind of low end of the risk range to the top end of the risk range, and really it's just sort of math probabilities, and I personally don't really think too hard about it, other than when is the kind of trend reversal and/or regime shift, right, in that asset class. So there would be a trend line in Aussie dollar. I don't have that on me at the moment, but I know with the dollar itself, with the US dollar or the DXY, that trend line's down about 103 and a quarter. So that line's going to be pretty critical in terms of how will the dollar act? Does it draw all the way down towards it, which is basically $3 lower than where it is today, or do we sort of sort of put in a bit of a base and go from the low end of the risk range back up to the top of the range, which, as I mentioned, is putting in a new high across the board on a 1 month and 3 month basis, which is kind of what we think about as a trade and trend. So trade would be 15 days or less, and trend is 3 months or more. So those are kind of what we think about in terms of price action and sort of signal strength.
I can talk about contagion.
Yeah, let's do it. Yeah, contagion.
In terms of contagion, well, I don't know really about like the crypto exchanges, but what I think about contagion is right. We have like you can look at the second chart I gave you guys. I don't know if that's Generon who has it, the Fed deposit liabilities, but right. I think about it in terms of risky assets, right? So first you start with crypto. Then you get the high yield, then you get the mid cap, large cap, and then it works its way through the system. That's kind of how I've been thinking about contagion in terms of where we are within the cycle, right? It's going to first hit your most risky asset. That's going to be your Bitcoin and so forth.
Yep.
And so that's all I had to say on contagion.
No, I think that makes sense. Makes sense. Awesome. Raj. Thanks, Shiv. Thanks for jumping in, man. All right, Richie. Peace.
Appreciate it. Thanks.
Yeah, no problem. I think with the gold, I think gold is not so much of an inflation trade. I think it's. I think Keith mentioned this a while back. It's more of a rates change. So if the real rates come down, then it's a positive for gold. So I think when last week or when he said something, I may be starting to look at gold eventually. He may be looking further down the line when Powell stops raising interest rates and the interest rate starts going down. If that's the case, then gold may be going up. I think I would just listen to him for a little while to make that move and wait for him to make that move. But gold is not really an inflation hedge, if I remember him saying something like that. That's all.
Yeah, Raj, good call out, and I should have mentioned that as well. No, definitely, gold trades with real rates. So as those real rates sort of start to peak and roll over, that's again, we will wait for it to confirm, right, in terms of confirm signal strength and to kind of transition from bullish trade to trend. Just for clarity, it has done that over the last 2 days, or yesterday it went bullish trend. This week it went bullish trend. So it has done that officially. Now the question is, again, and especially with our outlook on kind of rates and certainly real rates and the yield curve inversion here in the U.S., it'll be interesting to see whether or not it holds above trend or if this was a big time counter trend move. So great call out, Raj.
Just on,
I was waiting for when you're going to chime in here, Mr. FX.
So the Aussies particularly and the dollar, if you look back at 2019 is like my go-to for when everyone says that, the gold trades against the dollar. 2019 like completely blew that out of the water, and it's the most recent one where gold and the dollar went up together. So it just depends what quad we're in. It depends where we are. It depends where we've come from and where we're going to. Gold isn't an inflation hedge. It's that like Raj just said, it's a play on real rates. So it depends on the path you're traveling. That's why Keith says it all the time. Gold's really hard because it's kind of a Jekyll and Hyde. It has two faces because it can go both ways. It can go both ways, literally with high correlation with the dollar or with real rates. So you just have to be really careful. And most recently, like March, like if you overlay a chart, I don't have it right in front of me, but if you overlay a chart of the Aussie dollar and gold from, I think, March 2022, it's basically the same line on a chart. So it's got correlation probably of, I don't know, 1, maybe not 1, but super correlated. It's all a dollar play. At the minute, it's all a dollar play.
Yeah, and I think, just going back to when I had talked about the last sort of, well, not to, but kind of early 80s where, dollar went from 85 to 160, and if I look at kind of gold, it did obviously, not obviously, sorry, it kind of did the opposite, went from 670-ish down to 284 over that same kind of time span, with rates, again, like it's a reflection of real rates and what was happening there, in conjunction, again, and then you also had the huge move in the dollar. So it was definitely inversely correlated in that component as well, or in that during that time frame, I should say.
Just if you'll allow me, just on please. Momentum, Gavin brought up momentum. Like the dollar has just been it's just been on its own. There's been nothing else. So like the measure that I have of momentum, I use 12 weeks. So basically it's just, is the price today higher than 1 week ago, 2 weeks ago, 3 weeks ago, for 12 weeks. So it can be a maximum of plus. If everything's gone up to the right in a straight line, it can be a maximum of plus 12. And if it's gone down and to the right, it can be a maximum of minus 12, right? So the dollar spent pretty much the whole of 2022 between plus 12 and say 3. So even when it was on dips, even when we were buying dips, it still didn't have, at least by my measure, negative momentum. And in the last week, last 2 weeks, it's gone from plus 12 to minus 12 in the space of 2 weeks. It doesn't mean it doesn't mean that the trend is changing. Again, that's just a measure of momentum. But if you're using that as a measure of, I guess people would call it oversold or overbought, it hasn't broke trend. But because it had that period of going sideways, it just means, in my version of it, so it means that week 12, 11, 10, 9, 8 were all kind of at the same price. So just as soon as it moved, it started to go down. That negative momentum hit all in one big massive go because it had spent that time going sideways. So all the prices got hit at the same time. And now it'll just do whatever it's got to do to, to build up that momentum again. But nothing ever nothing ever, but it very rarely stays at plus 12 or minus 12 for long periods of time. It always fluctuates. So even if it fluctuates around negative momentum, it means it's still going to go sideways here. So it's just, you just have to wait and watch and see what it's doing.
Wise words. And thank you for that momentum. That's really, that's interesting. And use that 12 measure, is that specifically for the dollar, or do you kind of use that across multiple asset classes?
No, I do use different measures, but that's just as an example, just because I had it right, in front.
Yeah, no, cool. Yeah, I just wanted to want people to not extrapolate your commentary across everything, right, Chris? As they might.
Yeah.
Cool, man.
Yeah. All right, buddy.
Anything else jumping out on your page, buddy? Before
I missed the first 20 minutes, but did you make it almost an hour without talking about crypto?
Yep.
Okay.
Pretty good. Although Brian Muni guy did comments about, but it wasn't quite the same crypto degree. But yeah, he did also mention it. And I wasn't expecting it out of Muni guy. But yeah, no, okay. We almost made it an hour, and yeah, almost made the whole session without crypto talk. But yeah. Which I think is a win in this day and age, right?
Exactly.
That's a win.
For the last 3 or 4 days, yeah.
Yeah, that's a win. No, it's been a good a lot of spin on the dollar today. So it's been on the dollar, the obviously rates, volatility. We've talked about all those aspects, widening risk ranges. Inverse correlations. Yeah, we talked about. I think we've hit almost all the subjects I wanted to review. So for these last kind of 15 minutes, I'll open it up. Anybody out there that's listening in that either has a question or wants to review something in particular that they're whether it's maybe not struggling, but that you're kind of need to talk about or vent or what have you, this is the forum, or we are happy to engage.
I was going to bring up before, I think, was it today on the macro show where Keith was talking about the curve, obviously the inversion, but then saying like, hey, maybe, the longer end is starting to kind of say something about, this recession coming up. And of course, just like on the behavioral side, I think it would be an interesting spot because in my read on it is that like everyone thinks that, bullish bonds are impossible. And I mean, the numbers would still suggest that to me. Like I'm not trying to make a bull case for bonds, but just to kind of watch what's happening on the longer end of the curve, to say like there's been a couple times this year where they push back and it's like, okay, maybe there's a chance. And it's also interesting, the timing and kind of the divergence between like this counter trend move that started in currencies and equities, and then and now we're starting to see like that quick move in yields a little bit later, not like in sync. So it's just got my attention. And I mean, I think going back to the gold thing, like Chris basically said it, I think too, but it's like, I think that initial move in gold, it traded with yields, and then that like he mentioned, that inverse correlation to the dollar is still there. So maybe that starts to weaken, but since about May or so, that's not been the case. So it's like if then questions, like if gold was still bullish on Keith's signal and I got it at the bottom of the range, would I buy it given my situation with the dollar right now? Like I might, but then it's also like, okay, well, what's my purpose? Like my portfolio is geared towards long dollars still. So it's like, why would I do that? And try to do that when that correlation is still there for the time being. So it's like, it's going to take some time to play out to see like what it's actually going to do here. But I think for now it's just, it's traded with yields. So
yeah, I mean that gold risk range, Gavin, is interesting, right? Because it's basically the top end is new 1 month, 3 month, basically new highs across the board, but then that low end is the same thing, would be new lows across the board. So it's you could drive I think one of those you could drive multiple those huge Caterpillar
Mack truck
thingies that they have at the gold mines. I don't know what those are actually called, but you can drive multiple of those things through.
Those things.
Yeah, those things
those
are
massive.
Big. Hey, you ever seen those? Or you ever seen those pictures of like the operator standing in front of the wheel, and he's like, basically you need like 4 of them in order to make just one of those wheels. Anyway, but yeah, that thing, you could drive multiple of those through that risk range. It's a good call out, Gavin, right? In terms of like, okay, like if you do get 1625, does that are you changing your opinion, or sort of like, are you taking advantage of that? And I'd say right now, even that would I would not be stepping in front of there. Now, if that low end of the risk range started to creep higher, that might change my tune, right? If that started moving up to, I don't know, let's just say, I'm picking a random number, but like it moves up to 1680 or whatever, right? And all of a sudden, volatility starts to kind of come out of that risk range, and it starts to narrow a little bit. And could you see a higher low? That could get interesting, because then it would be probably flirting with trade and or trend again, right? And seeing what it wants to do.
Hey, Robert.
Yeah, John, welcome.
Hey, thanks so much for taking me.
Absolutely.
Hey, quick question for you. As we're hanging out and we're just kind of figuring out when the next opportunity is to go crazy and go long, which is going to be a while.
Yeah.
I've got a little bit of stockpile of cash, and so what I've been doing is buying the 3 month. I could sit out and get the cash, 3.5%, but I've been trying to buy some treasuries and some high quality municipals that are yielding, 4 or 5% in the next 3 to 8 months. Or I should say 3 to 12 months. Is there any other recommendations you have as we try to, capture the best yield as we wait for the next time to go obnoxiously long?
Basically risk free.
Yeah. Well, I don't know. After all this blow ups, I don't know if there is any risk free anywhere else.
No, I mean, I think that's we've talked about doing that kind of on this on this show a number of times over the summertime and that kind of thing, and obviously the yield has gotten better. I mean, at Dallas last week, John, I know that some of the guys were mentioning that they were kind of legging into things like an SHV, which is the short treasury, or sorry, the shorter term treasury bond, right? So very similar to I think it goes 3 to 6 months or 0 to, so it might go 9 months. I forget. So look into the SHV. I kind of forget which duration it is. But it's definitely on the shorter end. And, one of the things, that dividend basically keeps stepping up in terms of, like in October, it was like 20 cents. And here at the beginning of November, it was like 24 and change, or like 24 cents. So, obviously, anyway, so some folks are going, kind of the ETF route rather than going into the T-bills. But again, I think it just depends on what you're comfortable with and that kind of thing. So there's definitely a couple different vehicles out there that you could kind of look into, but I think the conservative nature of that transaction is a good one.
Okay, and then let me just one other follow-up question to that. So as we wait for Keith to make his determination that the rates are kind of locked in place and we're going to see a slow glide path towards the 2% or whatever it might be, I don't know, just down.
Yeah.
In my personal investments, I'm kind of at that age of retirement, and so I wanted to lock in some of the lower, or I should say higher yielding, lower risk. And I've been looking at federal agency bonds as with step up clauses and they're AAA, so they're rated by the federal government. So any other thoughts around there? I mean, is it, if we start pivoting off a quad 4, is that the time to start
I would
thinking about?
I would propose that to the arena, John. So go and see what folks have maybe done, and kind of see if there's anybody in the arena that might be able to help sort of not necessarily guide you, but sort of just gives you some ideas. I think that'd be a really good use of the arena, and just sort of seeing what maybe some other folks are doing. Generally, though, to answer your question in terms of kind of yes, I mean Keith has kind of alluded to it over the last week, right? In terms of some more of the quote unquote traditional, aka the back tested components that are positive. Now, again, what you also have to remember is, again, I'm making a number up, but if XYZ is back test 64% of the time, well, that means 36%, of the time it's it's negative, right? So, or it's not back testing positively. So it's just keep that in mind. But yes, I mean that would be, again, to pivoting towards the dollar, gold and treasuries, or kind of the fixed income. That would be a more traditional kind of like basket, right?
Yeah, I'm just looking at and I'm not looking at locking in, the majority of my retirement. I'm looking to lock in, 10 or 20% for a duration that, just in case things are a little bit more wacky than we think they will be for a longer period of time. I got some yield out there that I don't have to worry about, because we just lived through a decade of pain here with 0.25% of,
100%. And Turtle just jumped on, so I know he's an IA out in San Diego. I don't know if he's doing anything in particular for his clients, but he might be able to give not necessarily advice, but because we don't give advice on here, but just sort of some color. And then so Turtle, you're on mute, but I don't know if you had anything.
Yeah, real quick, John, and also just for the group, love to get any thoughts. Muni guy, any of you bond guys that got thoughts on this, I'd love to hear them. Check out BSJN, these Invesco bullet shares, BSJN. You get your money back, return of principal, December 23. So 13 months out. yield. It's a high yield bond fund. They have a investment grade version as well. Pays 7.5 yield to worst, and again, you get your principal back in 13 months. So I know, I'm a little so I'm interested. I'm interested in anybody who's got comments on it. Obviously, high yield's not where we want to be, and 4 straight quad fours. But the return of principal makes it a little bit more interesting. So really, it's not like even if, trust me, I'm not worried about compliance. Who am I? I'm a mystery. I'm a ghost. But but I'm less concerned with. So I have no problem recommending things. Not this is less of even that. I'm just actually more so soliciting feedback. So that's one I've been checking out. The investment grade version is also interesting. I'll take my, if anybody's got comments on that, I'd love to hear them.
Yeah, I don't have the official signal on BSGN, but that did not perform very well during this ramp throughout the first half of this year. So I would just be cognizant of what's inside of there. However, yes, the return on principal, obviously, again, I think there just needs to be a bit more due diligence hurdle. But what I would recommend again is maybe take this to the arena boys, and I think it'll spark a lot of good conversation.
Okay, what is the arena voice? I'm sorry.
The arena boys, aka you two. The arena is inside of the Hedgeye.
Okay.
As a subscriber,
Okay, gotcha.
there's it's called the arena. It's like where it's kind of like the chat board. So if you just start a conversation there, you'll be able to kind of everybody can see it and participate.
Okay. Is that okay? So I got the macro show call. Oh, there it is. Okay, sorry.
At the top,
the very top one. I've
never
clicked on it.
Yeah, perfect, awesome, man.
Thank you, guys.
You got it.
All
yeah,
right,
that's
thanks.
where and that's where you'll be able to find. So the show on Friday, 11:30, Beginner's Guide, Hedgeye Nation, a Beginner's Guide. It'll be aired directly in the arena, and you can anybody who wants to watch that, you can either watch it live or the replay.
Thank you so much.
You got it, John. Totally, man. Arthur, did you have a comment or question?
Yeah, a quick observation and maybe a comment on how I'm positioned for it. So in listening to the call and all the thread through a lot of the macro shows has been that we're going to get into this earnings recession, and it's just starting, and it's going to get a lot worse, which seems to be directly correlated to junk and high yield on the short side. And I'm there, and they're at the top end of the range. And to me, that looks pretty juicy in here. And I'm just wondering if I'm missing anything, or if you could comment on those two ETFs.
No, I mean, I think you're thinking about it properly. I mean, the top end is a hair higher on the high yield, right, on the HYG, which we get
about 25 cents.
Yeah, I know. I'm just being. Hey, you got to be specific, right? Like,
I actually don't have the top of the range on JNK. You know what that is off the top of your head?
I don't. I mean, I got it from the ETF Pro. That'd be 90.
Oh, okay. That's where I have that. Okay.
Yeah. So that would be the trend duration, right?
Okay.
So that'd be. It's actually not that far off from where it was yesterday. Really, at the end of the kind of the top end of where it was yesterday. So we are definitely close, right? So no, I mean, I think you know what to do. I mean, we got multiple quad fours on the horizon, and again, I don't know. I've been on here, so I don't know if he's what RTA. I think I saw an RTA come through, but no, I mean, I think again, this is the time to execute, Arthur. Right, when you've got yield curve is inverting further. You've got your U.S. fixed income treasuries pushing to the low end of their ranges. Certainly on the 10-year and the 30-year, and again, I don't have a live move quote, so that'll be interesting to see where it kind of closes. I get at the end of the day, so be interesting to see kind of where that ends up. But if it's still kind of in this north of 120 range, then that squarely remains in the F bucket, and so yeah. So I mean, I think just execute, man.
Great, thanks.
Yeah.
Just wanted to
make
sure I wasn't missing anything.
No, you got it.
Hey, Robert,
this earnings recession is going to be
yeah.
very. I mean, again, I know you kind of went through the 2002 range, but I can't. I mentioned it 2 weeks ago on the Beginner's Guide, and I'm reiterating it today. But if you get that, themes up deck, the mid-quarter update this afternoon, the new deck, go check out those slides. They're about halfway through. I think it was one. I forget which ones they are, but
I've got the I've got
go
the
look at that.
Pass.
Go look
I
at
don't
those
have
Qs in the
Macro
S and
Pro.
P, the earnings, the 5 in a row. I showed it earlier. It's definitely, you definitely take a look at that chart. I think it's very eye opening in terms of.
Okay, yeah, that chart, yeah. Okay,
take a look, because it basically, right now, in terms of Q3, what's being reported would be equivalent to the Q1 of '01 timeframe.
Okay.
And that's, so we had 3 more quarters beyond that of quad fours, and earnings just basically kept, they just kept sliding lower. So like earnings growth went negative in Q2 of '01, and went from a positive, basically 1% down to minus 13, down to minus 18, to minus 16, and then accelerated back up in Q1. So that's Q4 of '01 to Q1 of '02, but still negative, minus 2. So again, even though we may get the rate of change accelerations there, that as I mentioned earlier, that may on paper be putting in quad ones and stuff like that. I think we're just going to have to basically be patient, wait and see what the signal actually says, and in terms of where we position the portfolio and how we navigate those waters between now and then.
Great.
Yeah.
Thanks
you
for
got
all
it,
that. Appreciate it.
You got it, man.
Hey.
Yeah. Matt.
Hey, Robert, can you hear me?
I can. Sorry,
Okay.
I didn't mean to kind of speak over you there. Yeah.
Oh, no worries. This is my first time.
Welcome.
Well, I've listened in a lot, but first time with a question. So thanks for having me. So I got a question around, Coach always talks about, similar sets in, a cross asset class, setups. And, I feel like there's a lot going on right now. And not really feeling again.
I know what you
feel
mean.
Anything. But, we're kind of talking about, dollar towards the low end of the range. We've got bond yields towards the low end of the range. We've got, the move towards the low end of the range, the VIX towards the low end of the range, equity indices pretty much all towards the top end of their range, high yield towards the top end of the range, gold towards the top end of the range. But I also see there's a substantial amount of patience in signaling, I guess, coming from Coach, from RTAs and just in general, without clear direction on, movements. And I guess I'm trying to just figure out what am I missing, or is it just literally hey, I just gotta, practice my patience?
To me, it's practicing patience, Matt. Right? I mean, there's a number of things that, although we've pushed the top end of the range, certainly yesterday, right now, today on the S&P at 39.56, we're kind of not significantly away, but that top end is north of 4,000, just above 40.20. So we're not quite there. The VIX is in kind of in the middle of where it could be, in just around 24 and a quarter, with a low end down at 22 and a half. So I think just patience there, right? Waiting for the setup. That VIX risk range, as I mentioned earlier, is squarely in the chop bucket at 22 to 28. So right now, I mean, we're kind of operating the chop bucket endeavor, and there's no real need to kind of press anything, especially where we've been lucky enough to make money this year, right, Matt? So I think kind of waiting for that setup. But in general, I mean, you're seeing everything you're seeing is the right way of looking at it. And so then, and again, I'm going to repeat myself because I think it's important. These risk ranges are incredibly wide. Amazon's, if you go to kind of some of the big boys, I mean, the low end of that range is, it's 16% lower from yesterday's close. Apple is something similar like that. Apple's even crazier, actually. Apple's like minus 12, right? Minus 13, which is a huge move for these big, mega, sexy seven, as we love to see them, right? So, and those low ends of the ranges remain, kind of significantly below the most recent lows from last week. So that's the other thing too. Again, like just kind of as you're looking at those risk ranges and looking at where the top end and the low end are, it's important to kind of understand, like just kind of visualize where if we probably, if the probabilities hit, and we go from kind of near the top end to the low end, what does that mean from a price standpoint or from like a momentum standpoint? So, yeah. But Gavin's got commentary, I believe.
I was just going to say I've written a note down a couple of times when Keith has said, if you get outside, so for me, like I've just been looking at this and saying, okay, we have like OPEX on Friday. It seems logical that the market makers would want to kind of keep things around, 4,000 on the S&P. But in terms of patience, I've written the note down a few times where Keith says, like, if you get a big move on an event day, like an OPEX, I just think, obviously, like I'm set up too. Like, so if the market snaps back and fades, like I'm going to make money. It's just a question of how much money am I going to make, right? So but I do have shots, and maybe Keith is just like waiting on it because he knows that event is there Friday into next week. It could be light volume. Things could get pushed around, and maybe, you want to keep an extra, clip of ammo just there, just because maybe there's some nice opportunities.
Yeah, for sure. That makes a lot of sense for that.
How many days are the markets closed in the US for the holiday?
Just Thursday and then a half day on Friday. So it closes at 1.
So you have to squeeze 21 trading days of vol into 19 and a half days.
Yeah.
Okay.
And I'll let you come back on that, Robert. I don't want to put words in his mouth. I just am like looking at my notes thinking maybe that's part of it. So.
No, listen, I've at the top of my notebook almost every day for the last week. He keeps pounding the table and saying the same concepts, right? It's like, when did you execute? And basically kind of like sticking with patience and process, right? So like patience, process, execute, and minimize the feelings. And I think that's the key thing, right? Is not necessarily, is kind of, just trying to be diligent in executing on the fringes. For instance, yesterday, in terms of taking incremental adds to core position, or so like, incrementally adding to core positions, was certainly has proven in 24 hours to be a prudent move. Will we get better pricing? I don't know. The risk range is saying right now that it's possible that we could get some better pricing on something like a QQQ, or like the Nasdaq, right, or the S&P versus where it certainly closed and or kind of put in a cup of coffee yesterday. So, that's the big thing in my opinion, is just kind of trying to stay as unemotional as possible. It's very challenging, especially where I think we're very data driven and very. It's not that I think. I know most folks on this call are very data driven. And so when you see the data that's looming on the horizon, hence the title of this call, Quad Force Loom, it's, it can be a bit mind boggling to, see, big kind of these bear market bounces, because you just are sitting there thinking, what are people seeing that I'm not seeing? Because I think we have absolutely, the best macro research around. And it's a phenomenal team everywhere from to Josh Steiner and the team there does a phenomenal job across the board. Christian Drake, Drago, Richie, Keith. So I think just sticking with that process and executing when the time is right. All right, so with that, we'll wrap up. There's 20 minutes left in the day. Keith, send out. There you go, Matt. Short Google, buddy. So go read that risk range.
There we go.
There you go, boss. There you go. Live and in action. You got a freebie out there, Twitter, a freebie RTA. Probably shouldn't have done that. I'm probably going to get yelled at that for doing that. So we'll pretend like that didn't happen. Awesome, guys. Thanks for another great show, and we'll be back next week's day before Thanksgiving. So we'll figure out what we'll do next week with Thanksgiving, but it'll be on likely on Wednesday again. We'll kind of keep it standard, but I'll obviously just take note. And again, as I said, beginner's guide on Friday, 11:30 You can find it in the arena at Hedgeye. You got to be a subscriber to get access to that. Looking forward to it, and thank you everyone who who joined, who contributed. Always a pleasure.